decades. And you know, Mike, what's interesting is that she's talking about making investments in Italy to grow the economy, which is something that needs to be done in this country as well.
Yeah, look, what you see in Europe, what you see in Italy, this is like a looking glass into what America's looking at. They're at 140, 150% of debt to GDP. They're looking at, their long-term goal of growth is 1% GDP growth. How do you get out of this debt trap? Once this debt becomes so overwhelming, once the government becomes such a large part of your overall economy, it becomes almost impossible to grow. Because if you think of GDP as a pie, right, it's only the private sector that grows the economy. So if the government's 20% of the economy and you've got the private sector as 80%, well, a GDP that grows at 4, you're going to have 3 plus, private sector grows at plus 4%, you're going to have plus 3% growth for the overall economy. But if the government's half of your overall GDP, now you're down to 2% growth and so on and so forth. So the government, the larger it gets, it crowds out the private sector and it permanently hampers your economy going forward. This is much of what the United States has done over the last few years during COVID. The massive expansion of our government has permanently hampered us. We still have a little bit of time to right the ship, but
we've got $32 trillion in debt. That's the last time I checked. In this country. So she's watching. I think Mike Lee jump into this because that's the big thing here. Is this the forecast that we're all looking at? He's right, in particular when it comes to the technology companies.
Yeah, Ross. So we are in a really interesting situation where all three major indices are a stone's throw away from all-time highs, despite the Fed going through a very historic rate hiking cycle. Earnings this quarter down 7%, a slowing economy, maybe recession, maybe no recession, but somehow we've gotten this multiple expansion since November that's been over 30 or 40%. How much longer can this continue? And it seems eerily like 2007, where everything looks fine until it doesn't.
Sure. I mean, the thing about how long it can continue is these momentum-driven valuation expansions can actually last longer than you might expect. But at some point, you're right, earnings have to come through and deliver, or multiples will have to contract given the high rate environment. So you're at 19.
We've already talked about it a little bit this morning, but this is a 99-year-old trucking company. This is Yellow. Reportedly, they have shut down operations. They failed to modernize ops on stalled talks with the International Brotherhood of Teamsters Union. So a Yellow spokesperson, issuing a statement to our team, and here's what they told us, quote, Yellow offered to pay its employees more, a lot more, but the Teamsters leadership refused to negotiate for 9 months and instead made their intentions clear: destroy Yellow. Mike, this is the biggest failure in this industry we have ever seen.
Yeah, so look, sign of the times in terms, this is one of our first major bankruptcies through this Fed rate hiking cycle. A company saddled by debt in an industry that seems like it should be doing really well with all of the e-commerce that's going on right now. But we are seeing a bit of a whiplash effect that's affecting all the way across into the freight industry, where the excess purchases and the supply chain backups that occurred during COVID are finally rearing their head, where warehouses are getting full and freight traffic is slowing down because there's nowhere to put the goods. So at this moment, this actually comes at a pretty good time where, eliminating one of the participants in the market will help the overall market. A lot of these other participants like XPO Logistics are short drivers, so it should be easy for a lot of these drivers to go out and find work. The Teamsters are going to blame Yellow Trucking. Yellow Trucking is going to blame the Teamsters. I think the devil's somewhere in the details, but they are no more. XPO Logistics, Old Dominion Freight Lines, they should be looking at a massive earnings bump here now that you take out one of the major players right here. Bank of America, I think it's going to be up to 40% for some of the other participants in the market. So interesting situation right now. Really unfortunate to see kind of an American icon go by the wayside. But I mean, the knock-on effects are going to continue for a while, because now that this company ceased operations, if you have something on a yellow truck somewhere in America, there's no one sitting there in a customer service office, so it's going to be difficult to find your goods. All of their major assets are pledged to their lenders. Again, the Treasury owns 30% of this, so it's
the taxpayer.
Yes,
the taxpayer is losing, Mike, really quick. And before we run, I want to bring this up because we spoke with Darren Hawkins, their ESG-related investments. I mean, Mike Lee, do you think he's got a point? I think he does. ESG's been a disaster.
Look,
I'm sorry.
I have a friend who's much smarter than me, and he calls ESG the greatest scam ever perpetrated on Wall Street. So it's what happens is, so Vanguard and BlackRock are essentially passive investing firms. So Larry Fink gets all this credit as this really smart investor. He runs a passive investing firm. So most people are putting money in an index fund in their 401k, and they're just forgetting about it. And somehow they've managed to get shareholder services firms that are woke as woke can become, that get the proxy vote for all these shares that they own. If you manage a passive investing firm, you should have no control or say over what the underlying companies do, because you are a passive investing firm. And the fact that they've moved our entire country through corporate America so far to the left, okay, to the detriment of not only the shareholders but also the citizens, it blows my mind how we've gotten to this point. And yes, it does mimic communism. This is a case I've been making for years.
Liz, you have to wonder if this is why what Musk is saying. Glad you brought that up. They could have filled it up a lot cheaper than they can now. And if they wait much longer, if they do see $100 a barrel.
Well,
it's a disaster.
During the heights of COVID, the price of oil went negative. Donald Trump was loudly yelling from the rooftop, we should be buying as much oil as possible, sticking it in the Strategic Petroleum Oil Reserve. Where would the U.S. be now had they done that? That was shot down by none other than Nancy Pelosi and other congressional Democrats. But look, coulda, shoulda, woulda. We are in the situation now. In the last inflationary super cycle we had of the 70s and 80s, there was a double top of inflation, and inflation definitely has trended downwards. Okay, a big drop in the PPI, the Producers Price Index, which typically leads the CPI, is a direct result of the price of oil coming down dramatically. So if oil reaccelerates, look for inflation to reaccelerate.
And by the way, it's not just oil. The whole commodities index, the Bloomberg Commodities Index, has begun to turn back up again because of wheat, because of the problems in Ukraine, and other commodities affected by the war. So we're not out of the woods. I hope it doesn't happen, but it looks very much like that part of Bidenomics is in trouble.
Listen to this. Phil Flynn is a Fox News contributor.
Yeah.
His energy report this morning, listen to what he writes. It's titled Pay Up. And he says, after the end of SPR releases, recession fears, liquidity drain, the markets, they were ignoring the looming supply squeeze. The coming supply deficits are getting too big to ignore.
Yeah.
Deliver. Mike Lee's on set with me. He's got a question for you.
Kenny, look into Amazon. Microsoft, 25% year-over-year growth with Azure. A lot of that is coming out of Amazon's cloud computing, or Amazon's cloud server, or AWS's cloud growth. Do you have any insights into that? What do you think we're going to see? Because the last quarter, Amazon had 15% year-over-year growth off a massive base, but the street was unimpressed. I'm almost inclined to say I want these names to miss, so there's an opportunity for entering the market here because they recover on every single one. But how do you, if you had your best guess, how do you see this playing out, and what are your action plans?
Well, this is what I just said, Mike, right? Is that everything is priced to perfection. So if they miss even by a little bit, you could see a pullback. And to your point, I'd love to see some of these stocks pull back, just like I loved when Microsoft pulled back. But I'd love to see Amazon and Apple pull back. But, I don't have necessarily insight on where I think those margins